You know, the whole financial system, it can feel like this super complicated thing, right? Like this tangled web of jargon and charts that only experts can understand. But honestly, at its heart, it's not about algorithms or Wall Street wizards. It's really about solving a very simple, very human problem. And it all starts with a single question.
So let's start with something we all know. You put money in a savings account, right? But have you ever really stopped to think about where that money goes? I can tell you, it doesn't just sit in some dusty old vault. No, that money becomes a crucial part of this massive interconnected system that's designed to move money, not just across the globe, but between today and tomorrow.
And that right there, that's really our first big idea. The entire financial system, from your local bank all the way up to the global stock market, it exists to solve one fundamental challenge: moving our resources between the present and the future.
Okay, so for any of this to work, you basically just need two kinds of people. On one side, you've got the savers, and that's anyone, people, companies, even governments with money today that they want to use sometime in the future. You know, saving up for retirement is a perfect example. And on the other side, well, you've got the borrowers. These folks need money now for big things like starting a business or buying a house, and their plan is to pay it back with the money they're going to earn down the road.
I love this way of thinking about it. It's like the financial system is literally a time machine for money. See, every single dollar that a saver sends into the future is a dollar that a borrower is pulling into the present. It's this perfect two-way street. It has to balance.
All right, so if we're moving money through time, what's the actual stuff that's being traded around to make all this happen? Well, it all pretty much boils down to two very different ways you can put your money to work.
So on the one hand, you can loan your money out. We call this debt, and a bond is a perfect example. You're basically saying, hey, here's my money. I expect you to pay me back with interest on a set schedule. Pretty straightforward. Now, on the other hand, you can actually own a piece of something. That's equity, and stocks are the classic example here. With a stock, you're not just a lender. You're buying a small piece of the company itself, and that gives you a claim on its future profits, which is great if things go well, but a little riskier if they don't.
Okay, so we've got savers who have the cash, and we've got borrowers who have the big ideas. We even have the stuff they're going to trade. But how in the world do they all find each other in this huge global system? Well, that's where the financial intermediaries, the system's official matchmakers, come into play.
Probably the matchmaker you know best is just your regular old commercial bank. Its job is actually pretty simple. It takes in deposits from thousands of savers, people like you and me, pools all that money together, and then it lends it out to borrowers who need a loan for a car or a house or to get a small business off the ground. They are the ultimate connectors.
Now, outside of banks, you've probably heard the terms brokers and dealers thrown around, and they can be kind of confusing. So what's the difference? Well, think of a broker like a real estate agent. Their job is just to find someone else to take the other side of your trade. A dealer, though, is different. A dealer trades directly with you from their own inventory. They buy from you when you want to sell, and they sell to you when you want to buy.
All right, so we've covered the why, moving money through time. We've got the what, things like stocks and bonds, and we've got the who, the matchmakers. The last piece of the puzzle is the where. Where does all this action actually happen? Turns out it's in two very distinct but connected arenas.
First up, we have what's called the primary market. And you can think of this as the delivery room for a stock. This is where a security is literally born. So when a company wants to raise money, it holds what's called an initial public offering, or IPO. This is the one and only time that money flows directly from investors to the company itself in exchange for brand new shares.
Okay, so the IPO happens, the company gets its money, but then what? What about all the trading that happens every single day? Well, all of that, every single time you buy or sell a stock on your phone, that is happening in the secondary market.
And this is a really, really important distinction. So let's be super clear. In the primary market, the money goes from investors to the company. But in the secondary market, the money and the stocks are just being passed back and forth between investors. The company isn't directly involved in those day-to-day trades at all.
So let's just pull it all together. It's actually not that complicated when you break it down, right? The whole system is just built on a simple human need, moving money through time. It uses assets like debt and equity to do it. It's all made possible by intermediaries like banks and brokers, and everything happens in two main arenas: the primary market for creating the assets and the secondary market for trading them.
So, what does this all mean for you?
Well, the next time you move some money into your savings account or you buy a stock, just remember, you are not some passive bystander in this massive system. You are the saver whose money is being moved through time. You're actually casting a vote, providing the capital that helps decide which companies, which projects, and which ideas get a shot at building our future. So the only real question left is, where is your money going?